The S&P 500 plunged nearly 250 points in 3 days last week. Exactly the pullback we've been waiting for. Is this finally a buy on dip moment we discussed, or is there more downside ahead? Let's break it down. Let's start off with that S&P 500. When we were extended almost 300 S&P points above the 50-day moving average back a week ago, one of the things we were highlighting was that mean reversion back towards the 50-day moving average is a very typical thing to expect from just the ebb and flow movement of market price action. So we got this 3-4 day pullback in the markets and became a stone throw away from the 50-day, fulfilling the criteria for a short-term pullback. This is the scenario that we actually were talking about for weeks, which was that inevitably we were going to get some sort of a little pause and then a continuation. So the big question here, is this already a buy on dip? Should everyone be expecting that next leg higher for the full double top retest of the January highs? This is entirely on the table. And in fact, it is the path of least resistance. The primary trend is up. We're above all our moving averages, higher highs, higher lows. All the momentum remains on the short term with the bulls. Now, when we get to intermediate to longer term, I think that there's a lot more bear cases to be made. But at this stage, expecting the stock market to actually have one more leg up should be the starting base case. So what I'm looking for is whether or not we can actually clear this 5,900 level where we're trading. That's where that 61.8 on an hourly chart basis is. That really confirms then that the market is actually following through. And at that stage, a realistic short-term target would conveniently be right along its previous highs. You see measured moves line up all the way with previous highs, 6,100 to 6,150 on the S&P futures become the short-term level. So we're talking about 2 to 250 S&P points upside potential with the downside risks of still, let's say, one more correction coming down towards the 50-day moving average. And so that's the way we would be approaching the S&P. Now, how do I think this plays out into the summer? Well, once we do that kind of testing and find resistance, I actually am still bearish going into the summer. I still think recession risks and earnings contractions and all these different things are real risks, but they are not immediate risks that are here in the remaining days of May and going into early June. And so right now in the short term, we're just looking for follow through on the prevailing momentum that's been in place. And then we'll be looking for the turn point signs that the market is really rolling over later this summer. So I want to move on here to the volatility index. And this is in itself somewhat of a warning sign for me in terms of the fact that I don't want to get too bullish on the upside beyond a quick retest of the highs. We continue to have elevated levels of volatility. And this is quite customary when you are in the midst of a bear market. You're not going to see a scenario where the volatility premium goes back down to the 12 handle on the downside, basically allowing participants to buy a cheap downside market insurance. And so at this stage, with the fact that we stayed in the mid to high teens and now are back above 20, even during an update like this morning, we still have a scenario that is the elevated levels of volatility are a red flag that that overall the market remains in a fragile state. I want to touch quickly on the NASDAQ. Obviously, NVIDIA is going to play an important role here when we get NVIDIA's earnings later this week. Will that drive that bullish retest the highs with the S&P 500? I think that NVIDIA will dictate the degree of momentum to the upside, and that's going to be very much hinging on whether or not they're able to meet investors' expectations on those calls. So let's move on to the US dollar. So the US dollar has done a key bottom retesting very close to previous lows. Our main thesis has been that while the prevailing downtrend and bear market of the dollar is clearly becoming evident, that I don't suspect that we are going to have a big downdraft in the dollar in this first half of the year. And so I'm actually looking for the support line to hold. That doesn't make me bullish, nor am I looking to do some big high conviction bull call betting, that we're going to see 104, 105 on the dollar index, but rather, and we could very likely trade back to the top end of its range and grind in sort of like a ping pong match between support resistance lines as the dollar unwinds its very oversold state and then sets up for what could be a pretty big move later this year. When we look at Bitcoin, I just want to touch, continues to hold at higher highs. This break of the resistance that happened last week is significant, and we want to give the bulls the benefit of the doubt at this stage that they're going to be able to follow this through. At this moment, a measured move on the upside is actually at this 120 to 130,000 on the upside at this stage. With the breaking to higher highs and holding old pullbacks, we have to assume that the bulls are going to have enough gas in the tank to maintain this trend. Now, at any one moment, a pullback of 5 to 10,000 is a typical retracement, and this is the hard part: is that whenever someone sees like a 5,000 point pullback, immediately triggers like this fear of like, oh shit, it's about to turn and sell off. But recognize 5 to 10,000 point pullbacks in Bitcoin are actually normal, and with the 50-day moving average sitting right around the 100,000 mark, that makes it a very logical place for pullbacks to find short-term supports and subsequently still continue higher. I'm assuming at this point that this bull trend is still intact and there's no signs of topping formations or other things that would make us concerned that some sort of a short-term top is in. Let's talk gold, down $75. As much as it's a big number, we're only really reversing Friday's up day. Overall, we are actually at a very important moment where gold is coming along this trend line along the top. So far, it's held the 50-day moving average, it's held the fib zones, it's trying to break out. 3,300 is still a very important level in my mind. We did clearly close above it on Friday. Today, we're testing that level right now. We want to see whether the bulls buy the dips and get this thing north of 3,400. If we do, the measured move is all the way to 36 to 3,700 on the upside of gold. But we do need to see this hurdle beat for gold to be off to the races. All right, I want to just touch on crude oil here briefly. Crude oil, is this going to be a short-term buy and dip? I'm still liking this idea. Look, it's a double bottom. It's unloved. Everyone hates it. Everyone has a bearish story about it. Nobody wants to touch it. And that's sometimes when the biggest money-making opportunities are. I want to talk about this later in the week as well. But right now, what I want to simply see is that this entire flagging formation consolidating below the 50-day doesn't make a lower low. We want to see this look like a right shoulder of a consolidation after a double bottom's been placed, and maybe it sets up for a potential bull breakout on the upside. The next thing I wanted to just briefly touch on is some of these other commodities. I want to just highlight that uranium, obviously. Oh, first of all, we're on precious metals. I just want to highlight that platinum had that amazing breakout. Palladium hasn't held it as much, but platinum has held it. And so far, what we want to see is if they can keep it during pullbacks above 1,000. So if this, let's say, throws back $40, $50 and holds above 1,000 and then uses that as a kind of a springboard to launch the next bull advance, this could be a key turning point in this metal. The other thing I wanted to touch on is the bull momentum in uranium. Obviously, headlines coming out about the current Republican administration becoming favorable to nuclear expansion and friendly to the uranium story, which caused quite a bit of gapping higher on a whole array of uranium names. This is a legit breakout, and you want to be bullish uranium here. Do you buy this gap higher today? Well, you certainly can be accumulating if you don't have any. I like buying dips generally, but this is a bull breakout, and I do actually think that we're in the early innings of another bull phase here in uranium. And so let's see if they can sustainably hold above the moving averages and keep building upon this momentum. Finally, I wanted to just have a brief chat about these treasury bonds. So the long bonds have bounced after a double bottom retest, but is that enough? Is that enough for the selling to have subsided? Well, to me, it's all going to be about this bounce. If we see, notice here the 50-day moving average lines right along the fib zones, and so all we are going to be watching here is whether or not we have rejection along those moving averages that keep bonds sustained on the downside. There is very little to no bullish momentum whatsoever. All we had was an incredibly oversold bond market that just reacted the other way. At this moment, we want to respect the prevailing downtrend. The vulnerability here is if this support line gives out, there is immediate downside risk for a direct retest of the 2023 low, which lies around this 107, 108 level on the downside of these long bonds. And that's where we'll wrap it up for today. That's your macro outlook. Have a good trading day.